Hello student, this is Dr. Athir Iqbal. So far I have discussed various components of cost of capital in which I discussed in previous lectures how to calculate a cost of debt, preferred stock as well as common equity. And in the previous lectures I also described the concept of capital structure and how we calculate its weight and how we understand the contribution of various components. Now, in this lecture, I will discuss the weighted average cost of capital, the main crux of the chapter that whatever we have discussed so far will be used here. So, if you haven't gone through the previous lectures, first complete the previous lectures to understand the various components, and then you can understand this lecture in a proper way. This is the formula that looks very tricky, but if you know the various components, you can easily calculate it. Weighted average cost of capital, as the term is indicating, that is, it is taking weight of various components of capital. So the first part that we will take is percentage of debt in our portfolio. This I discussed in the first lecture, that how we calculate weight of any particular component of capital structure, and whatever percentage of debt you have, you will multiply after tax cost of debt. For this component, you can go back to the debt lecture in which I discussed that how to calculate cost of debt and how we deduct tax rate if given in the question. The second part is percentage of preferred stock, as well as you will multiply it with the cost of preferred stock. And the last component is percentage of common equity in our capital structure, and then we multiply cost of common equity. So I'm reminding you that each and every component we have so far covered in various previous lectures. So once you have gone through all the concepts, then the weighted average cost of capital will be much easy for you to understand. Over here, I am illustrating it with a much easier example. Let's suppose that this is the company in which a capital structure is provided. Corporate tax rate is 35%. And the question is asking you to calculate weighted average cost of capital. In simple terms, we call it WACC. Debt amount is 20 million, preferred stock is 10 million, and common stock is 50 million. So if I ask you what is the weight of each and every component, so I'm reminding you that with the help of taking the sum and then take the percentage of each component, you can easily calculate weight of each component in capital structure. These are the required return. I'm assuming that you are already familiar that how the required return is calculated in previous lectures. Over here, this is given in the question that debt requires 6% cost and preferred stock 8% and common stock 12%. If these informations are given and tax rate is given, remember that this tax rate will only be deducted from the debt required return. This tax rate will not be applied on preferred stock and common stock. So we will use the same formula: weight of debt and cost of debt 1 minus tax, weight of preferred stock and cost of preferred stock, weight of equity and cost of equity. And these are the various terms that you are already familiar with. We can use it. Now, student, in the previous slide, you see that over here the market values was given in million. In this slide, I converted into a simple amount, and now I'm taking its total. So if you take its total, you can easily calculate the weight of each and every component, which is coming like this. And the debt component is showing 25%, preferred stock 12.5%, and common stock is 62.5%. These are the weight that you calculated based on individual investment and divided by the total uh, capital of the firm. Once you take these components, carefully see the weight that you calculated over here is coming here. Cost of debt, preferred and common equity is given, and as I discussed earlier, that tax rate is only deducted from the cost of debt. So you will take this 6% and multiply it by 0.65 to calculate the required cost of debt, and the respective rate is given over here. Once these rates are clear, you will simply take this cost, multiply it to the weight which is given here. So resulting answer will come like this. And if you will take its sum, which is 9.48, so this 9.48 will be called weighted average cost of capital, in which we are taking weighted average of various components, whatever given in the company. So this is the cost of capital, which we started earlier, and we discussed that this rate is important from the firm perspective, because whatever project firm is planning, or wherever they are planning to invest, they always consider whether the return they are able to get from the project is higher than the cost that they are required to pay to the capital providers or not. So in this situation, if I say that the cost of capital is 9.48, it means that if firm is able to invest in any project which gives more than 9.48 return, then that project will be profitable from a firm perspective. And in case if a project is profitable but the return is less than 9.48%, then that project will not be feasible for the firm to invest.